Boom, people, welcome back. In this video, we're gonna talk about the differences between a Reg A, a Reg CF, and a Reg D fund. First off, what are they? What are the differences? What should you consider when choosing which one to go after? So you know all that. So down to the iPad of truth and justice here. We're on the 4-step fund launch formula. We're gonna be zooming in right down here, and you can see I've covered some stuff up here that I'm gonna unveil here in a second. So I'm gonna talk about most common. Now, we've talked about this. We've already talked about the GPLP structure. When you're talking about frame 2 of structuring your fund, all these types will work within this framework. Now, there's other frameworks. There's an LLC construct framework. There's other ones. But what I'm telling you here, 99% of all funds on earth use this structure right here. Furthermore, I'm going to say 98% of all funds, okay, use right here, a Reg D 506 fund. So let's talk about that first, and then we can talk a little bit later about Reg A's and Reg CFs as well and how those play in all together. But I'm sharing the most common fund types. There's one more fund type we might touch on briefly, would be a Reg D 504. Anyways, we'll go from there. Now, these are all under the SEC. The SEC has different, they have, Reg A, B, C, and then this is Reg D. Under Reg D, there's a few different ones. There's Rule 506, and then there's a 506B and a 506C, which you can see here. So let's unveil these. What are the differences of each one of these? Again, I'm starting with the biggest one. This is, 99% of all funds ever started are one of these two right here. So let's go and let's look at the intricacies a little bit here. So let me undo this. So Reg D 506B, okay? In a Reg D 506B, you can have 35 non-accrediteds. You can raise unlimited amounts of capital. You cannot advertise, and investors self-verify if they're accredited or not. Okay, that is in a Reg D 506B. This is the most common. As of a few years ago, they came out with the Reg D 506C. Okay, the C is right here. You can raise from accredited investors. You can raise unlimited amounts of capital. You can advertise, you can publicly do advertising, but the fund must verify accredited investor status. Now, let me zoom out for a second here. Why would you even choose one of these? Okay, you are choosing exemptions from different rules inside the SEC. And pretty much every fund uses these exemptions. They've built these exemptions on purpose, so for people like me and you to go out and raise large amounts of capital without having too much regulatory headache. If we didn't use these, you'd have to file like a public company to raise capital. These allow you to be exempt from some of those rules that you can file and raise money with different sub items. So we follow the rules within each one of these categories. Okay, so under a Reg D 506B or 506C, a few nuances here. The advertising is a big one. So what does this mean? Let's just describe this for a second. Underneath these ones, you cannot advertise here. And what that more nuanced means is you cannot do, and I'm going to use my little writer here, they do not want you to do general solicitation. Solicitation, okay. General solicitation, meaning running ads, big email campaigns, mass messaging. They do not want that under a 506B. This is why you don't see Blackstone running ads, okay, or KKR running ads. It's actually legally they cannot do it. And for a lot of different reasons, they can't do it, okay? Which is pretty interesting. So most of it has to be word of mouth or people that you already know. Then it's like, well, Bridger, then how does anybody know if I can't advertise, okay? Again, it's general solicitation. Now, I've read a lot of these rules. I've talked to, I could say, probably a dozen different lawyers on this specific rule. The way the rule is written with no action letters, it's kind of a gray area. I'm being honest. I've talked to 12 different lawyers. I've gotten 12 different answers on specifics of general solicitation. What is okay and what's not okay. I've had some people tell me what you can do and can't do, and other lawyers say, no, you can do that. And it's a little bit up for interpretation. And maybe it's written that way on purpose. And so I'll give you my sense here. So for example, what this means, general solicitation. If we're sitting next to each other on a plane, okay, and we're talking, what do you do for work? And I say, I can advertise, I can talk about the general partner and management company. Hey, I run a number of investment funds. We help people in real estate and we do a GP stakes for, we help with a lot with that. I can talk about what we do here. but I can't pitch you on my fund. I could not say on a plane the first time I've met you, hey, we've got a fund, our IRR is 23, and we're, the investment's a period of a 4-year investment period and all the details of the fund. And hey, do you want to join? That would be considered general solicitation. We have to have a pre-existing relationship. So, for example, if we were on a plane and we met and we talked about it, and we traded business cards and we said, hey, maybe 2 days later, I text you and say, hey, do you want to go to lunch next week? Sure. And we go to lunch, and then now we have a pre-existing relationship. Then I can pitch you the fund. Okay. That's what one law firm would tell you. They do not want you to generally solicit. So can you talk about your general partner? Yes. And your management company? Yes. Talk about that all day. I'm only going to pitch my fund, though, to people that I have an existing relationship with under this rule. And some firms will say you have to have 15 days of relationship or 30 days of relationship or 2 days. I've heard all different answers, okay? Existing relationship. The other side, if you're trying to play this really safe, the other side is just don't do general solicitation. If you don't send mass email campaigns and post on your social media about your firm, you're probably going to be fine. You're not doing general solicitation. Okay. You're not going door to door. You're not speaking at a big conference and pitching your fund on stage. Okay. That would be general solicitation. Okay. Hopefully that makes a little bit of sense. Over here on the Reg D 506C, let's talk through this one. You can advertise. Both of my funds right now are Reg D 506C. So my Ugly Unicorn Fund and Fund Launch Partners are both Reg D 506Cs. We did that because I am on social media so much, and I'm probably going to talk about my funds, so I want to be able to advertise or talk about my funds online. That's what we did. Now, so what we have to do, the fund has to verify all investors are accredited. So for example, with Fund Launch Partners, someone comes in, they want to invest. Great, here they are. We do a couple of things. We have to verify that they are accredited. The easiest way to do that is we have a lawyer or their personal CPA. They sign a little paragraph document that Joe Smith is an accredited investor. And they send that back to us. We actually have a DocuSign with a pre-thing. We just send it to them on DocuSign. They sign it, fill it back, come back to us. Pretty simple. If that doesn't work, there's another software called verifyinvestor.com. They have a team, they'll take your tax returns, whatever, to verify that you're an accredited investor. Okay? They send it back to you. Once that's verified, great, and you're accepted into the fund. Over on a Reg D 506B, what happens? We ask the same question on our documents, but the person, Joe Smith, by himself over here would just say, they just check a box. Yes, I am an accredited investor. And the burden is on them, not on the fund. If Joe Smith says he's an accredited investor, then guess what? Joe Smith's an accredited investor. They self-verify that they're, so if he could lie, I don't have to check. It's not my burden to check. On a Reg D 506C, it is my burden as a fund to check. I have to check and make sure they're an accredited investor. So, Bridger, what's the big difference? It's a little more of a hassle to do this. It's a little bit more of a hassle to do a Reg D 506C because you have to verify. We've had a couple investors. It took us 3 or 4 weeks to verify that they're accredited. The vast majority, it's pretty easy. We've had a couple that's been a little bit hard, and anyways, that's just the nature of the game. But we are allowed to advertise, so it's worth that trade-off. All right, hopefully that makes sense. Okay, continuing on. Let's continue on Reg D 506B. Underneath here, so once you choose, let's say, hey, I'm going to do a Reg D 506C. Okay, that's the one I chose. Check. Underneath there, you are most likely, almost always, going to do one of these exemptions below. Again, further exempting from the Investment Company Act and all these other acts of the 33 acts, okay? So down below, there's 3 of the most common ones pretty much everybody will use. And I'm going to walk you through each one of those, okay? The first one is a 3C1 exemption. So for example, on your Form D, you would select, hey, we're doing a Form D. We're under the rule 506 and then 506C. You'd select, there's a little box, you check the box. Then underneath there, we would check a 3C1. So if you see how it dovetails out of here, we would use that exemption further. What this exemption says is that we are going to raise from only 99 investors and all are accredited investors. Okay. That's what we're going to say there. So if you select a 506B and then do a 3C1, all of your investors are accredited and 99. This overrides the 35 non-accrediteds. It's my understanding. Now, there's a few other ones that you can get those non-accrediteds in, but there's a lot of burden that happens when you bring them in. You have to over-disclose to them, etc. Okay. My fund currently is actually both of them right now are 3C1 funds. The next one, 3C5. Okay. 3C5 is for real estate. 80% of your portfolio or investments have to be in real estate. This also can work for private credit, so mortgages or loans on real estate. Accredited investors only. And then you can raise from up to 2,000 investors. Okay. Now, again, to define what are we talking about here? A non-accredited investor is below this. A credit investor is $1.1 million net worth. A qualified client is $2.2 million net worth. Qualified purchaser is $5 million net worth. Okay. So here they are. You can take a picture of that if you want. So back to here, you'd pick this as very good for real estate. You can grab this real estate exemption. Okay, moving on. The last one is a 3C7. This is what all the big funds use, 3C7 fund. You can raise from 1,999 investors and all have to be qualified purchasers. Every investor has to have a net worth of 5 million or more. So this is why people like Ray Dalio, for example, was turning away investors. To invest in Ray Dalio's fund, you have to have a $100 million minimum commitment and a $4 billion net worth to even talk to them on their funds. Why? Well, he's only got 1,999 spots in their fund, and they're going to fill up fast. We got to get the most out of each spot. What the SEC has said is if, no one has 2,000 private friends, once you're over 2,000, you have to file like a public company, and you can file like you're a REIT or a mutual fund or a public, ETF. You can do any of those, would be more public. If you want to stay as a private fund with all the cool benefits of being in a private fund, you have to fall under these rules. And 3C7 is by far the most common. Okay. So, and then to dovetail this back together, when we talk about international feeder fund structures, you're going to see that we have 3C1 here. You can do parallel funds. So you have a 3C1 fund here that takes 99 investors here, and then a qualified purchaser fund that's a 3C7 that takes 1,999 investors. Okay, so you add those investors in, all of them would pro rata flow into your holding company. You can go check out this video if you want to see that one as well. All right, hopefully that's making a little bit of sense here. Let's move on now to, I'll erase this. Let's move on to Reg A's and Reg CF. So a few years ago, the Frank Dodd Act came out after 2009-8, and they had a bunch of things about crowdfunding and Reg A's, and it's been kind of this new space, okay, so where this whole space has emerged. So you have two different categories here. Both are somewhat similar. You have Reg A offerings and then Regulation CF, Regulation Crowdfunding. So let's go through each one of them. Now, both of them together here, to give you a summary, both can raise money from non-accredited investors, which is kind of cool. So you can raise from anybody. They can only invest 10% of their net worth or annual income. Okay. So if they make $100,000 a year, they can only invest up to $10,000 per person. Okay. You have to pre-identify the asset. They cannot be blind pool funds. And I would just call this thorough disclosure to investors. You have to there's a lot of disclosure that goes into these. It is probably, I'm just going to say 3 times the amount of cost of capital to run a Reg A than to run a Reg D. You have to hire, because these are non-accredited investors, the SEC is very concerned about them being, they're non-sophisticated investors. So you have to over-disclose to these investors. And there's a few nuances of each one of those, but there's just a lot more work. So you look at people like Grant Cardone or Fundrise or there's all these crowdsourcing places. The average check size for a Reg A, and I'll go down here for a second. Reg A funds, though, the average check size is about $550. Isn't that kind of crazy? Reg CF, it's about $250. So to raise $1 million, you are raising from thousands, if not tens of thousands of people. In a Reg D 506C, you're raising from maybe 5 people. So when over here, you've got a lot of customer service. Think of the tax documents, compliance. You're spending $30,000 to $50,000 a month in software and administrative costs just to run some of these at scale. Now you can probably do them more unique, but just a lot more money to run. They're also more money to set up. So what I tell people, I would only do these if you're ready to scale, if you have a strong marketing background around a scale. So what they are, Reg A, here they are. They call this a mini IPO. There's tier 1 and tier 2. This is the cap you can raise. So you can only raise up to 20 million on tier 1. Tier 2, you have to raise up to 75 million. The big difference is reporting. Reporting is a little bit more if you're going to raise a tier 2 fund. And then Reg CF, you can only raise $5 million within a 12-month period. You have to have a approved crowdfunding portal that the SEC has approved, and you have to pre-identify the asset, meaning you can't do a blind pool offering. Over here, these are what they call blind pool, meaning, hey, put some money in this fund. Over the next 18 months, we're going to find some real estate properties to buy. In a Reg CF, you have to identify the asset up front. Hey, we're buying 123 Main Street for $7 million. It's pre-identified. It's in a crowdfunding portal. We can only raise up to $5 million. So I said 7. That's too high. We're raising up to 4 million. Okay. Reg CF. But the big benefit is you can raise from non-accredited investors. So what I tell people, if you're going to go down this path, it's a fine path. Plenty of people have made money down this path. I would just make sure you have a strong marketing platform and a good back end to fulfill. If you're going to do a Reg A because you've got some friends that are all non-accredited and you have 20 friends that want to put money in, I would not do it. It is not worth the cost. Okay. Just don't do it. Maybe you go figure out to do the 35 non-accrediteds over here. Okay. This is not for just your offhand. This is for people at scale. You're Grant Cardone. You want to scale and do a lot of marketing every day and spend millions of dollars. Great. That's what I would say on here for Reg A and Reg CF, just because the cost to set them up are so much. So anyways, there's a review. There's Reg Ds, 506Bs, 506Cs. The vast majority of you, I'm guessing, are going to run Reg Ds, 506Bs. That's where we're going to go. A few of you may run Reg As and Reg CFs. If you got the right background, right marketing structure, you can actually do very well with these. They're both good options. Hopefully that helps. Let me know down below if you have any more comments.